Welcome to the Financial Resource Academy podcast. I'm your host, Kyle McCauley, and today we're going to tackle a critical question. What do you do when the market just won't cooperate? In this episode, we're going to discuss how to handle retirement planning and focus on what really works in times when asset prices are falling and headlines are loud. Here's the really difficult truth: the market does not care about your retirement timeline. It doesn't care about your budget, your risk tolerance. If you plan to draw down 4% or 5% or whatever percent you were hoping to pull from your portfolio each year, the rules that worked during your working years, such as buy and hold, dollar cost averaging to get that compound growth, they don't translate as neatly when you're taking money out instead of putting money in. And when the market's down, every withdrawal risks digging a hole deeper, especially in a down market. So today we're going to talk about what does work, not based on hype or crazy predictions, but really just based on systems, repeatable, deliberate processes and approaches to building income, even when the market, not only is it just not working for you, but maybe even it's fighting against you. So we're going to talk about why sequence of returns matters more than average returns in retirement. We're going to talk about how to shift your mindset from growth to cash flow stability. And then we're going to talk about some tools that exist, things like dividends, bonds, options, withdrawal sequencing. We're going to talk about all that. And we're going to talk about some ways that you could work some of these pieces together as a part of a coordinated strategy. So if you're looking for, loud noises or flashing lights or shouts of guarantees, you're in the wrong place. But if you're looking for a strategy, a way to think about things logically when all the emotions of the stock market and maybe even inside of you are really high, then you're exactly where you need to be. So let's get right into it. So I'm going to tell you about the shift that unfortunately most people are never warned about. When you're working and saving, volatility in the market, volatility meaning prices go up, they go down, that is pretty manageable for you when you are working and putting money in. Because if the market drops, you're buying, and maybe you're buying even more. And so you're thinking in terms of decades, not months or years, right? Single years or even months. And so because of that, you have time. The market goes down, no big deal. I buy more Apple stock today than I did last month because the price of Apple went down, just for an example. I'm not recommending Apple. But when you're in retirement, everything changes. Now you're not adding, you're subtracting. And when you subtract in a down market, you're not just withdrawing cash, you are compounding losses in that scenario. Okay, if I'm just buying a bunch of stocks, pick your stock list, whatever you want it to be. If I don't have a way that's generating cash for me, I have to sell those stocks to get cash in retirement. And if I do that when the market's down, I'm selling more instead of buying more. And so it's the reverse issue. This is really a big retirement income problem. And it's a bigger problem than most people realize. It's very dangerous. And it's been coined as the sequence of return risk. If you are not familiar with that, Google it, look up a chart. There's lots of resources out there about sequence of return risk, but I'm going to talk about it a little bit now, but you should get familiar with it. You've probably seen long-term average return charts that will say, the market averages 7 or 8 or 10%, depends on the time frame they're looking at. But that's, about right. Over long periods of time, The market will average, depending on the period you're looking at, typically somewhere between 7 and 10%. However, you never get this average in a straight line. And there is, in our recent history, a 10-year period where the stock market was virtually flat. And that period of time was the lost decade. The lost decade picks up the dot-com bubble, so the stock market crash that began in 2000 with the dot-com bubble and ended just after the 2008 market crash at the end of 2009. So beginning of 2000 to the end of 2009, pure price return, the stock market was actually negative. So the reality is you never get that average of 7 or 8 or 10% in a straight line. If you expand it 5 years to each side of that, that 20-year return is positive. And I don't know what it is off the top of my head, but it's probably over 7 or 8%. But the problem is if you retired in 2000 versus 5 years sooner, or retired, in the middle of between the dot-com bubble and the 2008 market crash, your reality is very different, even though the average of the market hasn't changed. So here's the kicker. Let's say you and I both retire with $1 million. We're both going to withdraw $40,000 a year, but we're going to need to increase that every year to keep up with inflation. You get strong returns in the first 5 years, and I get a bear market. Let's say the same average return over the coming time period, but by year 25, you're fine and I'm broke. The reason why I would be broke is because in those early years, I had to compound my losses to make up for the fact that my balances were down. So let's a simplified illustration. Let's say the returns for your portfolio and for my portfolio are positive 12%, positive 10, positive 9, positive 8, and positive 7. That's the first 5 years of your retirement. My retirement, I get negative 12, negative 10, negative 9, negative 8, negative 7. Okay. Let's say in the long run, over the next 25 years, that whole portfolio has the exact same average rate of return. Just because my first 5 years were especially bad, I probably run out of money, whereas you are probably totally fine. So the early losses kind of become an irreversible problem for the retiree. So it's very important for you to manage that early loss exposure, that sequence of return risk issue. So retirement planning is sort of like a math problem with a memory. Okay. When you take money out during a decline, you shrink the base of your portfolio that future growth is based on. And look, this is not academic. Part of the reason why I got started with a focus and focusing my career path focused on retirement needs is because a gentleman who I went to church with shared with me his story about how he retired in 2007 and lost so much money in 2008 and made some of the mistakes we'll talk about here in today's episode, that he ended up running out of money very early on in retirement. And so he was still working in his late 70s because he had to. Most people think that, well, if the market dropped, I'll just ride it out. Okay. In the long run, the market does recover. But if you need any income from your investments or you just want it, then you either have to stop spending so that you can recover, or you got to get a job so that you can still spend so that your portfolio can recover, or you're going to spend it, compound your problems, and you run the risk of running out of money. So very important to manage sequence of return risk. Part of the reason why popular rules like the 4% rule, which is that you can take out 4% of your portfolio, increase it with inflation, and you should never run out of money. Part of the issue is that it doesn't account for major market losses. The other thing that the 4% rule doesn't tell you is that's not foolproof. It only means that 90% of portfolios succeed when you run a test. The problem is that in a period like 2008, it's not 90% succeed. So just understand that the 4% rule was done in a lab, so to speak. It was produced by financial software, but that financial software is not stress test in every case. So very important to think about other strategies other than taking like a 4% rule, for example. Some things that the 4% rule does overlook often is, what if we enter a period of much higher inflation than expected? The 4% rule is based on a 3% inflation rate. So what if inflation's higher? What if you live significantly longer than expected? Okay, the 4% rule is based on a 30-year retirement. What if you have a 40-year retirement? What if interest rates are lower than the models predicted with the 4% rule? Now, right now, we're pretty close to the same, I can tell you that, as what the models predicted, but that could change again. It wasn't that long ago that we had 20-year bonds yielding 4.5%. Yikes, okay? Investment grade. So just relying on simple rules like a 4% rule doesn't necessarily account for current market conditions. And if you don't understand what the variables were when they generated the 4% rule, they may or may not apply to you. So that's why we're going to focus on something a little bit different. We're not going to talk about, how much you can withdraw from your pile of money and not run out. We're going to talk about how do you build a system that delivers income from your savings even when the stock market or economics aren't cooperating with you. So what we're going to talk about next is how we combine different income sources, why sequence buffering matters. We'll talk about sequence buffering, and how the mechanics of income planning can work under stress. Look, we're not trying to predict the future. If your strategy requires you to predict the future, it's not a good strategy. You need a strategy that can operate in lots of different potential future outcomes. Okay, here's why income planning isn't just about a withdrawal rate. See, a lot of people that I talk to, when they get near to retirement, and they'll ask me, how much should I have saved? Well, that's the wrong question. The question is how much is your portfolio generating in income? Because your pile of assets is really there to generate income for you. Think about it like this. When you went to your employer and they said, hey, we'd like to hire you, when you first were getting your job interview, and I'm going to guess that none of you asked, how much income will I make? No, I'm just kidding. No, you all knew, right? You talked about it in the interview and the hiring process, how much they're going to pay you. You didn't show up on day one and say, oh, by the way, are you guys paying me to do this? No, you knew going into it. And so the same thing should happen in retirement. You should go into retirement knowing what your assets, your savings, your pensions, your Social Security, your investments are going to give you an income. Okay, the same way that it was important to you to know going into your working years how much that job was paying you. Same thing here in retirement. You should know what your investments are going to pay you. Okay. There are two main types of income that you can get: fixed income and variable income. Fixed income are things that are going to have some kind of a guarantee associated with them. Okay, think Social Security, pensions, annuities. Okay, you could also add into that like treasury bonds, CDs. Okay, anything that has attached to it a fixed or guaranteed rate of return or guaranteed rate of income. That's going to be your fixed income. These are stable sources that you can count on. The variable income piece comes into play a lot more so when we're talking about stocks. So stocks often will pay dividends. So your dividends can change. It's not guaranteed. Same thing with bonds. If you have either bond funds or you are buying short-term bonds, because then you pick up reinvestment risk. And with a bond fund, you're tied to interest rate yields. If interest rate yields go down, your interest rate on your bond fund goes down. And so variable income can come into play there. And then anytime you spend principal, you are affecting your future cash flow forever. And so that would fall into that variable income as well. Economic conditions, market volatility, and personal choices. If those things affect your income, then it's variable income. The goal is not necessarily to eliminate variable income because variable income in the long run often ends up being the biggest part of your total income. The goal is to structure it in such a way that it allows you to handle the sequence of returns risk and puts you in a position where you can generate income regardless of what's going on in the world of economics. The safe withdrawal rule can fall apart for a few reasons, but one of them has to do with this interest rate variability. If interest rates go down over time and you have a substantial amount of your portfolio, 40% in fixed income or bonds, then the problem is those bonds over time are going to generate less and less interest. And so if you are in a position where you're generating less and less interest over time, then you can really put yourself at risk of the 4% rule, which is 4% of your portfolio at the beginning of retirement, increasing every year with inflation. More global uncertainty adds to unpredictability with stocks. So we can't necessarily count on our stock performance to outpace our bond performance if we're in a period where there's too much uncertainty. Lately has sort of been a good illustration for that for people. So with the stock market down, we have some issues where, are my stocks going to bail me out because maybe my reinvestment on my 6% yielding bonds is down to 4%. And now my 4% yielding bonds are down to 3%. And so stocks would need to bail you out in that scenario, but you have to be very careful because if we're into the next lost decade, for example, who knows? The other issue that you have to think about is that you want to rely on engineering your cash flow so that the investments that you have are generating or kicking off cash flow. Whenever possible, you want to avoid spending principal. Principal is the amount of dollars that you invested to begin with. So if I buy a CD for $100,000 and that CD is yielding 5%, and I spend the $5,000 of interest that CD yields, I still have my $100,000. And so if I only spend the 5,000, I will always have my 100,000. So avoiding spending principal is one of the key factors in making sure that you do not ever have the risk of running out of money. So long as you never spend principal, you shouldn't, unless there's some cataclysmic event like a collapse of the dollar. Okay, not to put too many bad voodoo out there or something. But the point is without that, then as long as you don't spend principal, you're never at risk of running out of money. Okay, so engineering your cash flow and spending only your cash flow is the single biggest solution to this. We also want to make sure that we do that in a way that makes our plan resilient. Okay, making a retirement income plan resilient will sort of encapsulate several things. Number one, that you have flexibility. Maybe you need a time where you need a little more income, but then you want to also be able to back off. Having flexibility to do that can be very vital to having a resilient retirement income plan. Having an income plan that's efficient from a tax perspective. So you want to make sure that you're drawing from the right accounts at the right time. You're not overpaying in taxes for no reason. So having tax efficiency will help make your plan resilient. The other thing is you want to have market adaptive income sources. So these are going to be income sources that really aren't going to necessarily participate or be really affected by periods of time where the stock market is volatile. So things like interest from bonds, dividends paid out from stocks, and covered calls from stocks. These are three sources of market adaptive income, meaning you were not necessarily reliant on the stock market to go up to get that income. We get that income whether the stock market goes up or down. And then the other thing is sometimes it's helpful to have a reinvestment plan from excess cash flow. So if you can build a plan, excuse me, where your income is more than what you need to spend, that allows you to reinvest some of that income and can be helpful in, especially in a down market, because then you can essentially do dollar cost averaging in retirement. Okay, we're not trying to predict what will happen in the future. We're about engineering a plan that's going to set you up for success, whether the market's going up or the market's going down. Okay, that's what will create for you a more resilient retirement income plan. We're not trying to just chase high returns or guess which stocks are going to go up or which sector of the economy is going to have a better year than the other. What we want to do is we want to have a coordinated strategic plan engineered to deliver income regardless of what kind of market is in our future, but is very resilient to give you flexibility, to manage taxes, and to put you in a position where you could even do some reinvesting even when the market's down, and maybe especially when the market's down. Let's talk about more specifically some of the types of income that you can generate in retirement. One investment that you can make is an investment in stocks. Almost everyone should have some amount invested in stocks because it's going to be the best source of long-term inflation protection. Now, there could be other things that might provide some inflation protection, like gold, for example. But if we're trying to take care of an income need while also handling inflation, your stocks are going to be the best source. Focusing on dividend-paying stocks is a way to generate income from your stock investments while you're also getting income. So the cool thing about dividend paying stocks is all you have to do is just own the company. If you own the company, your portion, when the company issues a dividend, they'll pay you. And so there are many companies that have a long history of increasing payouts and over time, keeping a very robust dividend schedule. And so adding things like that into your portfolio can be very helpful to you. One caution with this, though, is you don't want to just chase yield. High yield in dividends often means higher risk. There's a reason a company is paying a 10% yield when most other companies of high quality are paying 2 or 3% yield. It's not because that company is so much better. It's because there is something maybe more fundamental to be concerned about with that company. So be very cautious about high yields in the dividend space. Really for in the stock world, low risk, okay, so still high risk in terms of all the available options for investment. But in the world of stocks, a lower risk stock is typically going to have, that does focus on paying dividends, is typically going to have a dividend somewhere in that 2 to 3% range. Okay. The other thing that you'll want to consider are bonds. It's important for you to think about yield when you're looking at your bonds. Yield to maturity, yield to call. Okay, that's typically what yield to call means is if the bond gets called early before it matures, I'm only getting $1,000 per bond back. Well, if I bought that bond for $1,025, I'm going to lose that $25 when the bond gets called. Maybe that's still a good deal for me because the yield to maturity is 6.5%. But sometimes with your bonds, you need to be careful because yield to maturity might be 7, but yield to call might be 3. So the risk of getting called early is very high on a bond where the yield to call is 3 and when the yield to maturity is 7. So you need to be very careful with that. The other thing too is you need to make sure that you're paying attention to when your bonds are maturing. If interest rates go up by a lot, then you will have wished that you bought short-term bonds because you'll want to reinvest in those higher yields quicker. But what happens if interest rates go down? If interest rates go down, you're going to wish you had bought longer-term bonds. So thinking about that and managing the risk is very important to do. Doing that by laddering your bonds is probably one of the better ways to handle that, because you'll have some bonds that are maturing in the short term. You're picking up reinvestment risk earlier, but you're also picking up the potential if interest rates go up to buy higher yielding bonds than the current ones. On the flip side, you'll also have bonds that mature farther out. So if interest rates go down, your income is a little more secure than if you had only bought short-term bonds. The key is that if you have any time horizons that you need lump sums of cash, it's a great idea to make sure that your bonds are maturing on those schedules so that you have significant cash when and if you need it. One of the things that we talk a lot about, I talk a lot about with clients, and also we talk a lot about at the Financial Resource Academy, is using our stocks to generate additional cash flow like a bonus check. Best way to do that is through what is known as covered calls. A covered call allows you to sell your stock at a specific target price at a specific date. You're giving someone else the right to do that, to buy it from you at a specific price by a specific date. And so you sort of have to be okay with that ahead of time. Now, they may not buy it from you, so you might own a stock that's maybe gone down in price. But if you're going to own stocks, you have that risk anyway. So the point is you're going to own a basket of stocks. One thing you can do is you can sell a covered call where you're giving the right to someone else to buy that stock from you at a specific price point in the future, but they have to pay you that up front. So when they pay you for that, that is called a premium, and that payment to you is cash, and you could spend it, and it goes right into your cash bucket, and you get that income regardless. So if the stock that you own goes down in price and you were going to own that stock anyway, you were going to lose on that stock ownership regardless of whether you sold the covered call or not. The difference is if the stock goes up in price, you're going to be capping that growth, right? If the stock goes up 5% and you put it 7% out of the money, meaning your sale price was 7% higher than what it is today, and it only goes up 5, well, you'll own the stock still at 5% capital gain, and you'll have gotten your income from the covered call. But what if it goes up to 15%? Well, you capped your return at a 7% gain. So that's the deal with covered calls. Covered calls can be a great strategy for two reasons. One, it allows you to potentially do some reinvesting in a down market. So maybe I own 100 shares of NVIDIA stock. NVIDIA goes down in price, but I sold a covered call. That covered call income I use to buy more NVIDIA shares, and I sell another covered call, and then the price can still come back up. I still own my stock, but I was able to buy more shares of NVIDIA because the price went down. Okay. One of the other things to keep in mind is keeping your withdrawals dynamic. One example of this that happened very recently with the most recent market downturn is market downturns are usually because of high volatility. High volatility causes option prices like covered calls to go up in price. And so when that option price goes up, that means for those who are selling covered calls, they're getting more income in a down market. Kind of counterintuitive, but that's how it works often. So we have many folks that we talk to and work with that are generating more income, even though their account balance is lower. So what do? Well, we talk to them about the possibility of capping their income at a comfortable level, and then taking the excess income and using that to buy more shares of stocks. So staying dynamic with your withdrawal schedule and your income can really help you boost your overall performance. Again, especially in a down market, which is the kind of market that as a retiree, you really need to manage. One of the last things I want to talk to you about when it comes to this issue of structuring a retirement income plan when the market isn't cooperating is some of the emotional and practical considerations. Here's the issue. The biggest risk that you have as a retiree, single biggest risk, if I were to pick any one risk, is that the stock market drops big and you sell, right? You sell your, S&P 500 fund or your, basket of stocks. I just don't want to lose anymore. And you sell in that moment. I understand that impulse, but let me tell you, that is like the silent killer of retirement plans. It doesn't show up on a chart and it doesn't get modeled into Monte Carlo simulations because we can't, as planners, we can't predict when you might say that. So one of the things that is very important for you to do is to build a plan that you know ahead of time, or at least that you can commit to ahead of time, that if the stock market is down 10, 20, 30, 50%, it's wiped out in half, you're not going to make any changes. If you build a portfolio that accounts for that and puts you in a position where you're not going to make any changes, even if the market's dropped by, say, 50%, then you know you have a plan you can rely on. Okay? And very important to think about that plan in a worst case, not a best case scenario. Okay? Important also, you should have a plan with rebalancing discipline. Stock market drops 50%. You have a 60-40 portfolio. All of a sudden, your ratio is not 60-40 anymore. Okay. Your stocks are way down. So what should you do? You should sell your fixed income and buy more stocks. Whew. Feels counterintuitive, doesn't it? Feels scary, doesn't it? But it is the right choice. You should actually move out of safe money, cash, bonds, fixed income sources, and buy more shares of stock when the market really dives. It's going to feel super uncomfortable. You're going to think this is the worst idea. I'm going to kill myself with this decision. Not literally kill myself, but you're worried, right? I'm super nervous about what's happening here. Stick with it, be disciplined, and trust me, it will make a big difference. Okay, even when things feel emotionally wrong, oftentimes there's still the correct thing to do from an engineering perspective. The more you can stay like an engineer and less like a no offense to any of my counselors, but less like a counselor, the better. Okay. All right. Cash can really help you out. Having assets that generate cash, having some reserve, some emergency funds, having a cash reserve can help you to make those tough decisions of rebalancing in a down market. And trust me, that can really make a big difference. Okay, markets, they're always going to throw surprises to you. It's a feature, it's not a bug. Okay. If your job is not to try to predict downturns, okay? If you're asking your advisor to predict downturns, I hate to break it to you, but they're not good at it, okay? I have a couple of resources in my back pocket of people who are constantly predicting downturns. And you know what happened earlier this year when the market hit kind of a low around negative 20%? They said, see, we're right. And I didn't have the heart to point out to them all the times they were wrong not that long ago, where they were predicting downturns and the market went up a lot. So the problem with predicting downturns is eventually a broken clock is right? So that's the old adage. It's important to remember that sequence return risk is a very real problem. You need to manage your downside risk in a down market. You need to have a plan that has you set up where you can manage that volatility to a comfort level and that you can produce income even when the market is down. Try to avoid using static rules like the 4% rule. A lot of people like bucket strategies. They've actually tested it out. I hate to say it. Some advisor is going to watch this and yell at me, but the bucket strategy has been proven to not be the most efficient way to manage a retirement portfolio. So, they feel nice, they feel good. The age of 100 rule, those things actually are all wrong. And we know this from testing and research. The most effective plans are really going to be dynamic, specifically structured to meet your income goals, and with a pre-plan for how to handle excessive market risk. Discipline is going to matter as much as the numbers. Okay. All right. If you're already retired and feeling uneasy and you're trying to figure out how to make this all work for you, give us a call, reach out. We're happy to set up some time and look at these issues with you. You don't need to be perfect. You just need some clarity, probably. You probably need a strategy. If you're gearing up for retirement and you're not sure how much your retirement paycheck is, we can help you figure that out. Okay. This is what we do every day at the Financial Resource Academy. One quick disclosure related to that. Financial Resource Academy is owned and operated by Entrust Investment Services. I am one of the owners of Entrust Investment Services. Our team would be happy to speak with you about your retirement planning goals and needs. And so reach out if that would be helpful to you. We'd be happy to interact with you. If you've never attended one of our workshops, we'd be happy to have you do that. Probably want to subscribe to us on YouTube or Facebook to make sure you don't miss that. And we will connect with you soon.